Yeah, sure. I think you've actually summed it up quite well in your in your brief introduction. Um, Imagine it this way: before the 1980s, what big banks did was they lent money to businesses that actually produced things. So you would find that in those days, Citibank would be lending money to, let's say, General Motors, be lending money to other large corporations. The development of IBM, would all be financed by banks saying, yes, we're very happy to lend you money because we like your business plan. And they can see that there's a string, if you like, of earnings on the back of that bank lending. And it was secured on real assets like factories and where shares were taken in, you had a dividend stream as well. So you could see that the collateral that a bank took in actually properly backed the loans. Now that's a very important point. Then in 1980 we had the Big Bang, and what that meant was that banking became reformed. The Glass-Steagall Act, which separated out commercial banking from investment banking following the Wall Street collapse and all the banks that went out of business then, suddenly we forgot about that, so we'll rescind it. And it's inconvenient for the future. So they rescinded that, which basically meant that the big commercial banks like Citibank and JP Morgan and Morgan Stanley and White World and all these sort of big banking operations just went purely into financial activities. And it was the start of, first of all, regulated derivatives, and then you had over-the-counter derivatives, and then you had hedge funds. Purely, this is just playing around with bits of paper. And it's got so much that, of course, and the other thing, as far as these big banks are concerned, they can see the collateral value of this paper rise and rise and rise. Why? Because interest rates are falling and falling and falling. So this has really sort of fueled a financial bubble, which the banks have been very much part of fueling. They've expanded bank credit very much into financial services rather than lending to real businesses, which actually produce things, which produce an income, which justifies the loan in the first place. So you can see that it's all changed. It's completely changed now. And we have got to the point where we're really at the top of a bubble. I mean, when you see interest rates go to zero, I mean, that is the end of the trend. And of course, in Japan and in the Eurozone, I mean, they not only went to zero, but they went into negative territory, along with a few others. That was if you want a definition of a bubble, just look and see what has been happening in recent years. And that is the top of the bubble. So financial bubble, what happens when interest rates start rising? Well, here we've got actually rather a worrying story, because the reason interest rates are rising isn't because of nasty Russians withholding gas and whatever, whatever the story the politicians tell us. They always tell us this. But it's actually because the central banks have been printing money like billio, and the banks have been expanding credit like billio on the back of that as well. But this time it's actually mainly central banks that have been doing it. The result is that the purchasing power of their currencies has declined. They've been debauching their currencies, and that is why prices are rising. So we've come to the end of this trend where interest rates went to zero or even negative in some jurisdictions. They're now going to rise because when you see, look at Germany. Germany's just announced, I think it was earlier this week or last week, that the producer price index has risen 30% in the year to end March. There's got to be more to come, because that was really before the Russians, did the nasty thing, if you like, and said, well, we'll sell you oil at a reasonable price, but you got to pay in rubles. So that was all before that happened. 30%. And what's the ECB doing to interest rates? Since then, they have reaffirmed a deposit rate of -0.5%. I mean, this is crazy. These are markets that are about to break. It's as simple as that. And in Japan, if you go back into March, you found that the Bank of Japan, which has really, become an enormous portfolio of mainly bonds, but they've also been buying equities in ETF form. They said, we will keep interest rates where they are, which basically is sort of a little bit negative. And the 10-year bond, we are going to pin, this is yield control or yield curve control or whatever you like to call it. We're going to pin this at 0%. And then sort of 3 weeks later, they had to change that and said, we're now going to pin it at 0.25%. Now, you can't believe any numbers coming out of Japan. On the one hand, it is a savings-driven economy, so the tendency towards consumer inflation is lessened. But on the other hand, the government takes money which is printed by the Bank of Japan and uses it to subsidize transport and food and various other prices. So, do you believe the CPI there? No. I mean, what they're doing is they're printing money to suppress effectively to suppress evidence of inflation. I mean, this is just crazy. This is crazy. And it had to end. And the thing that will end it is rapidly rising interest rates. And markets haven't even begun to understand the ferocity of the situation that is now unfolding. So that basically is why I think to look at it in terms of the end of financialization is actually relevant to understanding what we have ahead of us.
Now, you mentioned along the way there the central banks rushing to debauch their currencies globally, and you've also written about that, calling it currency is collapsing. Can you talk to us about why that is such a pressing issue currently, why this is kind of like the warning lights flashing on the dashboard of our collective financial car, telling us that something is very, very wrong and urgently going to impact us?
Well, the first thing is just what we've been talking about, and that is what is clear to me, and I think will be increasingly clear to people in the markets, that interest rates are going to rise a lot further than are currently discounted in the markets. That's the first thing. And then we had this situation where governments, or rather the central banks, have been expanding the quantity of money and credit in circulation like drunken sailors. I mean, it's just incredible. Okay, you've always got an excuse, COVID, whatever. There's always a very good excuse to try and stimulate the economy and to stop it collapsing and all the rest. We had COVID, we've had supply chain dislocations, and that's ongoing, by the way. China, in Shanghai, 500 ships queuing to get in. This is absolutely impossible. I mean, that's going to continue on through most of this year because of the knock-on effects. And then in the middle of this, Russia walked in to try and take over the Ukraine. And the West responds by saying, you can't do that. We will sanction you. Now, hold on a minute. They're sanctioning the world's largest supplier, exporters of commodities. The largest in the world, bar none. And those commodities are principally energy and various other really important commodities. And not only that, but you've got little sort of niches like the Ukraine produces, I think, about half the world's neon or something, something extraordinary. So the effect in terms of producing semiconductors is actually going to be really quite catastrophic. And there is an even worse problem with that, which, of course, the politicians will not take the blame for. And that is the amount of starvation that is going to occur around the world as a result of our actions against Russia and, in connection with the Ukraine, because the Ukraine and Russia in the steppes are the largest exporters of grains we have. The Chinese have already cornered the market on existing stocks. Like they've got something like 70% of the world's maize, 70% of the world's wheat, got something like close to that with rice. They've got about 35% of the world's soybean stocks for 20% of the world's population, which means that the rest of us get to go whistle. And if that's not bad enough, you've got another problem coming up, and that is that the cost of fertilizer is just going to go through the roof because it's energy intensive. And not only that, but one of the big exporters of fertilizers is, guess who? The Ukraine. So you can see that this is a story which is going to get a lot worse over the course of this year. And I fully expect to see people starve in particularly the poorer nations in the middle of this year, later on this year. And food prices for the rest of us are going to be way high. You're going to have food banks and all the rest of it. I mean, the demand from families is going to be, I think, really, it will be really upsetting to watch. It really will. We've got this ahead of us. And it was all preventable, in a sense. I mean, if they hadn't printed the money in the first place, and if they had actually responded to the Russian invasion of the Ukraine, or attempt to invade Ukraine differently, then the situation wouldn't have been nearly so bad. So this is a very unpleasant thing which is about to happen to us, or is in the process of happening to us. I don't think we've seen the end of the price of oil rising. And the thing to bear in mind, to understand what's actually happening to commodity prices, is not so much commodity prices rising, but it's the purchasing power of the currencies that we measure them in falling.
Now, there are about a half a dozen of the 25 or so questions that were submitted ahead of your arrival here that deal with this particular point, and you've already touched on it in two regards. You've talked about the Bank of Japan and others who are keeping rates like pegged close to zero or negative even, and then you've also talked about that the natural force or effect will be on increasing interest rates. People are trying to understand how does that collision get resolved. DG says, why will interest rates hit 5 to 10%? Alasdair has mentioned this before, but what will actually drive this in detail? Will they not just force interest rates lower as usual, or will this not work, and why?
Well, I think we've got a very good example of this with the Bank of Japan's monetary policy at the moment. The Bank of Japan is just sticking to its Keynesian stimulating monetary policy. The result is that the yen is collapsing. I mean, the relationship between interest rates and the purchasing power of the currency is indirect. It's indirect in that you've got to look at it from the saver's point of view. With a fiat currency, the saver is looking at three things. First of all, there is the time preference. In other words, the amount of time that he has lost use of the money. That's the first thing. There is the risk involved in who the saver is lending his savings to. That's the second thing. And the third thing, which doesn't occur with a proper gold-backed currency, but happens with a fiat currency, is the saver's expectation of the purchasing power of that currency when it is returned to him at the end of the loan. Now, that is now suddenly rearing its ugly head. And what this means is that markets will cease to function unless interest rates actually respond to what the savers demand in terms of compensation for the loss of purchasing power. And most of your followers, I think, are likely to be too young to remember this, but some of them will. If you go back to 1980 and 1981, Paul Volcker raised the Fed funds rate to, I think, 19.2, 19.3%, which meant prime rates were over 20%. And what he was saying, in effect, to people with dollars was, look, I'm offering you 20% for you to deposit your money. Now, make up your mind. Do you want to get rid of it, or do you want to make 20%? And that was basically what he was saying. And he raised the Fed funds rate above the general market expectation of how the purchasing power of the dollar was likely to change, say, in a year's time. things were bearish at that time. And I think that expectations in terms of interest rates probably in the region of, a proper rate to discount would probably be in the region of, say, 15%, 12, 15%. So a 20% hike was really, you got to go for it. And it was that stopped the movement of savers out of dollars into goods and services. And consequently, it stabilized the dollar. And it was from that moment that the dollar started recovering. It was from that moment that the whole world started moving towards the financialization that we're now coming to an end of.
So, as with everything you've just described, then, you say it will be savers' demand for compensation for the time value of their deposits that will require, but that assumes a natural market where natural market forces and the participants thereof are the ones that are driving the day. Is that not different from what we're seeing, to the point that we're not in a natural market? So in the market that we actually have in front of us, do you see the potential or more likelihood, I guess, that we'll see policies like the Bank of Japan just keeping rates pinned as low as they can and buying up the mess that creates, persisting in other parts of the world like the U.S. and so on?
Yeah, I mean, the one thing I would say, and it's it's as much of a saying, but it's borne out by history, is that the markets always win in the end. I mean, governments can suppress or, they can believe this, that, the other thing, but and they can probably control prices or suppress prices, whatever, for a period of time. But it creates distortions, and after a time, that just doesn't work, and the market begins to take over. I mean, we saw this in the 1970s in this country, in the UK. The government of the day reckoned that for the government to borrow, a reasonable rate was, say, 6% or 7% or something like that. As far as the market was concerned, the market took a different view. And guess what happened? What happened was that sterling started tanking, which is exactly what the euro and the yen and now sterling are doing again. And the rate at which the government could fund its deficit was rising and rising and rising, because savers in form of pension funds, insurance companies, you and me and all the rest of it, we were looking at this and saying, we don't want to lend money to this government at 7%, 8%, 9%, 10%. And as the standoff continued, the situation just got worse and worse and worse and worse. And we're seeing this with Japan at the moment. I mean, what's the Bank of Japan doing? It's pretending it hasn't got a problem. Yes, it has got a problem. And, this is why the yen is just collapsing. And it will only be resolved when the Bank of Japan is prepared to address the issue and raise interest rates sufficiently to stop its currency collapsing. But then we've got a separate problem. And this is actually the dilemma that the Bank of Japan and the ECB finds itself in. Because of QE, and in the case of Japan, it's been doing it since the year 2000, believe it or not, they have accumulated an enormous portfolio of mainly bonds. In the case of Japan, they've added equities to it as well. And the problem with that is that when bond yields rise, the mark-to-market value of this enormous portfolio, which the central banks should never have ever considered accumulating, the market value of that starts going down. So on a mark-to-market basis, which of course they won't accept, because markets are, they're always right, markets are always wrong. But what it means is that we now have a situation where the Bank of Japan's liabilities exceeds its assets. In other words, if this was a business, and you and I were directors of this business, we would have to declare bankruptcy or protection from our creditors. But of course, being the Bank of Japan, they don't have to do that. We're different, we're superior. The law doesn't apply to us. And exactly the same situation is happening with the ECB. Now, I know how to resolve the Bank of Japan's problem, and that is that what the Bank of Japan does is it goes to the government and it says, we will lend you X billion or trillion yen, which, and that we record in our balance sheet on the asset side as money which is owed to us. But on the other side, instead of recording it as a deposit, which you can draw down on, because this is the way double entry bookkeeping in banks' accounts work, we will put it in another liability category called capital, equity, if you like, shareholders' funds. So that way we can recapitalize ourselves. So you can print money to recapitalize yourself. Banks can do this, not just central banks, but banks can do it as well. So this is not a huge problem. The problem is that you're doing this at a time of great embarrassment. And furthermore, the commercial banking network that you supervise is already over 20 times assets relative to its equity on average across the board. So you've got a highly leveraged commercial banking operation which risks falling over through this. And you've got a central bank which itself is insolvent. Now look at the ECB. The ECB has exactly the same problem, but the dynamics behind it are a little bit different. The problem the ECB has is it doesn't have a government to turn to do the operation I was just described. It can do the operation, but it has to turn to the national central banks in the Eurozone. But the national central banks in the Eurozone are equally bust themselves for the same reason. They have on their balance sheets loads and loads of bonds, which are going down in value because of rising bond yields. So they need recapitalizing as well. So you've got the ECB, which needs recapitalizing. You've got the national central banks that need recapitalizing. And you've got a target 2 system where there are imbalances such that the Bundesbank is owed about 1.2 trillion euros. And on top of that, you have got a most massive repo position, repos and reverse repos, where they are not, if you like, 2 sides of one transaction, so separate transactions. In the Eurozone, on the last account, which was about 18 months ago, totaled about 8.3 trillion euros. Now, why is this? Well, the answer basically is the attraction of zero interest rates. If you can get cash for zero interest rates, then you're going to find you're going to beg, borrow, and steal all this paper stuff that you've got knocking around. And and by the way, if you've got if you're an Italian bank and you've got sort of people going bust, just take their collateral and bung it in there as well. And so you've got all the sort of loans which you can use as collateral of very, very doubtful quality, and you take it off the local regulators' books, as it were, put it into the target 2 system via the repo system, and hey presto, we're solvent. So all this has got to be unwound, and I can't see how this is going to be unwound at all. It is. I think we're looking at the end of the euro. If the euro is around at the end of this year, I will be surprised. So the whole situation, if you like, internationally, is extremely concerning. And while, as I understand it, American banks have been keeping their exposure to the eurozone as low as possible, I think that that the systemic risk, counterparty risk in the international banking system is really going to mean that these problems are going to really hit the American banking system and anyone else's banking system as well.
In the environment of collapsing currencies that you just described in frightening detail, we have a question from a viewer, and this sums up another thread of questions from different viewers. Carl Lake says, am I correct that nearly all stocks, bonds, and ETFs will go to near zero in terms of purchasing power after the fiat currency fails?
I can see it going there, let's put it this way, because of the dynamics of the situation. The idea that stocks can give you protection against inflation is only true if the inflation is relatively moderate. And it's only true if the inflation is not going to worsen. So we have, basically what we have is a very different situation, because the rise in prices is going to mean that interest rates have got to rise significantly. And then the collapse in bond values undermines equity values. Not only that, but there is so much in the way of malinvestments in the economy. And this, it doesn't matter which economy we're talking about. All of our economies have got malinvestments as a result of interest rate suppression. You will find that businesses start going bust because they finance themselves on the basis that interest rates are zero or near zero, and they find they can't afford 15% or whatever it is, because remember, the spread will increase against them as well on top of rising interest rates. The Fed and every central bank, even those that have got a chance of surviving, do really have a dilemma, because they've got this dual mandate. On the one hand, target inflation at 2%, and on the other hand, consistent with full employment. And now what they're looking at you had GDP figures today which surprised everyone by coming in negative. These things are meaningless, quite honestly, but you can see the problem from the authorities' point of view. What do we do? We've now got a contracting economy. If we get another one of these, then it's officially going to be a recession. We'll all be out of a job if we carry on like this. Yet, prices are rising at 8%. What do we do? They really do have a problem. This dual mandate is really coming back to bite them very, very hard.
You also mentioned, so we've talked about financial and fiat currency strains and collapses. On the flip side of that are tangibles, real things, commodities, etc., that seem to be burgeoning, with the exception of silver in particular, but also somewhat gold. Eric MC asks a question that many are thinking. There seems to be no catalyst to drive silver and gold. Every headline seems to drive metals lower. Sure seems like manipulation. How can we escape the bank's control over metal pricing?
Patience is the answer. I'm sorry to say this. The reason this comes about, undoubtedly, is the vested interest in the establishment, and by this I mean the bullion banks, is to see lower prices for bullion and silver so they can close their shorts. The short position in the swaps alone on COMEX, has been in the region of sort of 40 to 45 $1 billion. We're talking about huge amounts. Average bank exposure in the swaps is probably in the region of $1.5 to $2 billion. This is serious stuff. So they don't want to see a rising price for gold. What they want to see is a falling price, and they can then close them off. And what we've seen recently is some success for the swaps, because the level of open interest on COMEX has actually declined quite sharply from, off the top of my head, I think we got up close to 600,000 contracts, and now I think we're down to sort of 540, something like that. Maybe more to go from the point of view of the swaps. Now, the other thing I would say is that the investment world, the investment establishment, your favorite investment manager, the guy who runs your pension fund, the guy who's in charge of the insurance company's assets, they're all Keynesian. And so their response is always Keynesian. And what they're seeing now is there is risk, heightened risk in yen, euros, sterling even, whatever else they might have in terms of foreign exposure. So what do? What's the risk-free thing? To a Keynesian, the answer is quite simple, and that's the dollar. So you can see that instead of sensible people, people who really do understand economics, understanding that this is a bigger risk thing which is likely to undermine the dollar as well, and bearing in mind that before this happened, foreigners already owned over 33 trillion. That's nearly 1.5 times America's GDP in dollars, in cash dollars, and also in financial assets. I mean, they're already up to there in dollars, and now they're going up to there in dollars, if you like. This is a very, very difficult situation. But if you're a Keynesian, where else do you go? They don't understand that the true hedge from this situation is actually physical gold itself. I mean, what they do is they say, I mean, if you're a Keynesian, you say, well, look, hold on a minute. We're seeing interest rates rising, which basically means that the penalty of holding an asset which produces no income is increasing. And you want me to hold gold? Now this is an argument they would prefer to see because it drives down gold relative to the dollar. And if you're in the banking business, you say, whoopee, this is actually what we want. And so these are the dynamics behind what is actually happening. But the other thing I would say is that the comment that your viewer just made is, I would associate with someone who's looking at gold and silver as an investment. In other words, something that they would hope to sell at a higher price at a later date, rather than true money, which actually should be hoarded. And the reason you hoard money is so that you spend it later because you're worried about everything else. So, if you like, I think that's the psychology behind the question. I don't want to put words in anyone's mouth, but what I would say is that the best way to look at this is you've got to hoard gold and silver, not worry about the day-to-day. If you see the big picture changing in favor of fiat currencies, then maybe you might decide to reduce your exposure to physical gold and silver. But I think that's extremely unlikely. If anything, I think the situation is intensifying. And as we've seen from the drop in currencies this week, I think it's intensifying very rapidly.
I guess maybe our last question then pushes a little bit farther here. Over the last 2 years, we've seen such a convulsive environment of emergency back on top of emergency, geopolitical strains, banking and currency, anomalies, that sort of thing. Bristleberger asks, under a worst-case scenario, governments may seek to nationalize gold and silver in, quote, the national interest. Are holdings more or less safe when held by private individuals or by businesses, such as storage vaults, if the government requires them to hand over bullion?
Yeah, well, first of all, I don't think that they will do this with silver. The logic behind the question is, of course, you've seen this in America before. We also had it in this country where the government turned around and said you can only hold 3 sovereigns or something. I wouldn't rule it out happening again. But the way to deal with it is to ensure that either you hang on to your gold and silver. Well, I can't turn around and say that you should break the rules that the government then introduced. But one way around this is to store it in vaults which are beyond the jurisdiction of your government. And there are 2 jurisdictions you've got to bear in mind in this. One is the physical jurisdiction. In other words, if you're an American, you might look more favorably on storing them in a vault in Switzerland. And the other thing is to make sure that you don't store them in a vault which is owned and operated by an American corporation. So that's another thing that you ought to bear in mind. And I would say that's, one of the things we do at Gold Money is we offer a choice of, 11, 12 vaults or something around the world. So depending on your location, you can use that facility if you like. I mean, you're not going to necessarily stop your government from confiscating your gold, but you can make it just a bit more difficult for them to do so.
I guess this leads into the other question. We often talk about articles that you either have just written or are about to write or publish. Where can people keep track of your latest writings? And in addition to finding you on Twitter?
If you go to goldmoney.com, hit the research tab, I write an article every Thursday. It comes out Thursday, sort of midday to early afternoon EST. And I do a market report the following day. And if you want access to vaults in other parts of the world, have a look at the possibility of opening an account if you haven't already.